Imagine selling a piece of real estate and using the proceeds to buy a new one. Sounds simple, right? But what if you could defer paying taxes on the profit from the sale? That's precisely what a 1031 exchange, also known as a like-kind exchange, allows you to do. Named after Section 1031 of the Internal Revenue Code, this powerful tool enables investors to swap investment properties while postponing capital gains taxes. This strategy can free up significant capital that would otherwise be owed to the IRS, facilitating portfolio growth and wealth accumulation. The beauty of a 1031 exchange lies in its tax deferral benefit. When you sell an investment property, you typically owe capital gains taxes on the profit. However, a 1031 exchange lets you reinvest those profits into a similar property, effectively postponing the tax liability. This means more money stays in your pocket, available for you to reinvest and potentially earn even higher returns. By deferring taxes, you retain more capital, compounding your wealth-building potential over time. The IRS allows 1031 exchanges for like-kind properties. This doesn't mean you need to find an exact replica of your current property. Like-kind refers to properties held for investment or business purposes. For example, you could exchange a vacant lot for a rental apartment building or a retail storefront for an office complex. The key is that both properties must be held for investment or business use and fall under the definition of real estate. 1031 exchanges come with strict timelines. After selling your relinquished property, you have 45 days to identify potential replacement properties. This identification must be in writing and include specific details about the properties. Once you've identified potential replacements, you have 180 days from the sale date of the relinquished property or the due date of your tax return, whichever comes first, to close on one or more of them. Failing to meet these deadlines can disqualify the exchange, triggering immediate tax liability. Section 5. The role of a qualified intermediary. A qualified intermediary, or QI, plays a crucial role in a 1031 exchange. This independent third party facilitates the exchange process, ensuring all legal and regulatory requirements are met. The QI holds the proceeds from the sale of your relinquished property, assists with identifying and acquiring the replacement property, and handles all necessary paperwork. Using a QI is not optional. It's a mandatory requirement for a valid 1031 exchange. Section 6. The same taxpayer rule. Who can benefit? The same taxpayer rule dictates that the taxpayer who sells the relinquished property must be the same taxpayer who acquires the replacement property. This means you cannot use a 1031 exchange to transfer property ownership to someone else, such as a family member or business partner. This rule ensures that the tax deferral benefit is only available to the original property owner. Section 7. Exploring different types of 1031 exchanges. There are several types of 1031 exchanges, each with its own nuances. The most common is the simultaneous exchange, where the sale and purchase of both properties occur on the same day. In a delayed exchange, the relinquished property is sold first and the replacement property is acquired later, adhering to the 45/180-day rule. Reverse exchanges involve acquiring the replacement property before selling the relinquished property, often used in hot markets where securing the desired property quickly is crucial. Section 8. Exclusions and limitations. What you need to know. While 1031 exchanges offer significant advantages, they come with certain exclusions and limitations. Primary residences and personal use properties are not eligible for 1031 exchanges. Additionally, you cannot exchange real estate for personal property like stocks, bonds, or artwork. Understanding these exclusions is vital to avoid disqualifying your exchange and incurring unexpected tax liabilities. Section 9. Seeking expert guidance for success. Navigating the complexities of a 1031 exchange requires careful planning and expert guidance. Consulting with a qualified tax advisor and an experienced qualified intermediary is crucial for a successful and compliant exchange. They can provide tailored advice based on your specific circumstances, ensuring you meet all legal requirements and maximize the benefits of this powerful investment strategy.